BlackRock manages 15.3 trillion. But just 3% of it generates 15% of its base fees. That is the number that explains BlackRock better than the giant headline. The company just crossed a record 15.3 trillion in assets under management, and the usual internet story is that BlackRock somehow owns all of it. It does not. Those assets belong to pension funds, governments, institutions, financial advisors, and individual investors. BlackRock manages the money and charges fees. The real question is not how much capital appears on the platform. It is how efficiently the company converts different kinds of client assets into revenue. Once you look at that fee map, BlackRock stops looking like one enormous index fund company. It starts looking like three businesses working together. iShares creates scale, private markets create higher fees, and Aladdin turns BlackRock's operating system into subscription revenue. Start with the misconception. Assets under management are not the same as assets on BlackRock's balance sheet. If a pension fund places $10 billion into a BlackRock mandate, BlackRock does not become $10 billion richer. It becomes responsible for managing that capital under an agreed strategy and fee schedule. This distinction matters because the phrase "BlackRock owns the world" confuses legal ownership, voting authority, client mandates, and corporate revenue. BlackRock can have influence as a large asset manager, and investors can debate how that influence should be governed. But the business model is much simpler than the conspiracy version. Attract client money, keep it on the platform, and earn fees without owning the underlying pool. The size of AUM measures reach. It does not measure how much of that money belongs to BlackRock or how profitable each dollar is. The second category error is treating every increase in AUM as new money won from clients. BlackRock ended March with about $13.89 trillion and June with $15.34 trillion, an increase of roughly $1.45 trillion in one quarter. Net inflows were a very strong $191.7 billion, but market appreciation added about $1.28 trillion, while currency movements and realizations reduced the total slightly. In other words, most of the quarterly jump came from rising asset prices, not salespeople pulling in another $1 trillion. That is not a criticism. Asset managers are designed to benefit when markets rise because the fee base expands automatically. It is also the central risk. A market decline can shrink AUM and fee revenue without a single client leaving. So the headline number is partly a distribution achievement and partly market beta. Investors need to separate those two engines. Now look at the fee structure. Institutional index mandates represented 26% of BlackRock's AUM, but only 5% of base fees. These giant mandates are extremely price competitive. ETFs represented 41% of AUM and 45% of base fees. A much better balance because iShares combines enormous scale with a broad product shelf. Retail clients were only 9% of AUM, but generated 23% of base fees. And then there are alternatives. Private markets and liquid alternatives together were just 3% of AUM, but they produced 15% of base fees. This is the hidden map. $1 of AUM is not economically equal to another. Low-cost index money makes the platform hard to displace. ETFs improve the economics while preserving scale. Retail raises the fee rate. Alternatives sit at the narrow end of the funnel, where specialized products can charge much more. BlackRock reported about $449 billion in alternatives AUM at quarter end. That pool generated $851 million of quarterly base fees. It also produced $237 million of the company's $305 million in investment performance fees during the quarter. That is roughly 78% of performance fees from a business holding only 3% of total AUM. Some of the year-over-year growth reflects acquisitions, including HPS, so investors should not mistake all of it for organic expansion. But the strategic logic is clear. If BlackRock can move more wealth and institutional clients into private credit, infrastructure, and other alternatives, revenue can grow faster than total AUM. Here is the question I would put to investors. Would you rather see BlackRock add another $1 trillion of ultra-low fee index assets, or $100 billion of well-performing private market assets? The first makes the headline bigger. The second may change the earnings model more. That does not make the ETF business secondary. iShares crossed $6 trillion of AUM in the quarter, roughly double its level 3 years earlier. ETFs brought in almost $178 billion of net inflows during Q2 and generated 45% of BlackRock's base fees. This is the distribution machine that private market competitors cannot easily recreate. Investors already use iShares for equity, fixed income, cash alternatives, model portfolios, and digital asset exposure. Advisors and institutions already have BlackRock products inside their workflows. That installed base lowers the cost of introducing another fund, another model, or eventually another private market allocation. So iShares does two jobs. It earns fees at massive scale and it gives BlackRock access to the client relationship. The higher fee businesses become more valuable because the low fee platform is already everywhere. The third engine is Aladdin and BlackRock's broader technology stack. Technology services and subscription revenue reached $566 million in Q2, up 13% from a year earlier. Annual contract value grew 15%. This is meaningful, but it needs the same reality check as AUM. Aladdin does not control every asset it analyzes, and it is not an autonomous machine choosing the world's investments. It is enterprise infrastructure used for portfolio management, risk analytics, data, trading, and operations. Clients use the system under their own mandates and controls. The economic attraction is recurring subscription revenue and deep workflow integration. Replacing a core risk and operating system is much harder than switching from one ETF to another. Aladdin also gives BlackRock a view of the operational problems large investors need solved, which can reinforce the asset management relationship without turning the software into a magical, all-seeing intelligence. This is why BlackRock increasingly describes itself as a public markets manager, a scaled private markets platform, and a global technology company. Public products bring distribution and liquidity. Private products bring differentiated fees and performance fee potential. Technology embeds BlackRock inside the client's daily process. The flywheel is more important than any one acquisition. An institution can use Aladdin to understand a portfolio, hold iShares for liquid exposures, and hire BlackRock for infrastructure or private credit. A wealth advisor can start with a model portfolio and later add private assets as access improves. Each relationship increases the chance that BlackRock earns a larger share of the same client's wallet. The company is not trying to abandon passive investing. It is using passive scale as the entry point for businesses with better monetization. The latest quarter gives the bull case real evidence. Revenue increased 31% year-over-year to $7.08 billion. Operating income rose 42%, and adjusted operating margin reached 45.9%, the highest in almost 5 years. BlackRock reported $192 billion of the total net inflows and 10% organic base fee growth over the last 12 months. The stock rose more than 7% after the report, but the quality of that growth still deserves scrutiny. Acquisitions added revenue and complexity. Private assets are harder to value and slower to exit. Fee competition remains intense in public markets. And because so much AUM tracks market prices, a broad decline can reverse part of the operating leverage. BlackRock's platform is becoming more diversified, but it has not escaped financial market cyclicality. The next BlackRock earnings report should be judged with 5 numbers, not 1. First, organic base fee growth, because it strips away some of the noise from market moves and acquisitions. Second, alternatives fundraising and fee-paying AUM, because committed capital does not generate full fees until it is deployed. Third, Aladdin annual contract value, which shows whether subscription momentum is durable. Fourth, adjusted operating margin, because the new platform only creates value if revenue grows faster than integration costs. Fifth, net inflows by channel, especially ETFs and active strategies. The $15.3 trillion headline will continue to dominate coverage. The better question is whether BlackRock can keep shifting the revenue mix toward higher fee, more recurring, and more deeply embedded businesses without losing the scale advantage that made the platform dominant. BlackRock does not own $15.3 trillion. It operates the distribution system around it. The investment case is that iShares supplies the scale. Alternatives improve the fee rate, and Aladdin deepens the relationship. The risk is that markets, integration costs, or fee pressure expose how much of the growth still depends on asset prices. Which engine matters most to BlackRock's future? iShares, private markets, or Aladdin? Leave your answer below and subscribe for company analysis built around the number the market is missing. This video is for education and research, not personalized investment advice.